Thanks for being here today. So we're going to dive in on the Saturday, events. I really like the Saturday, webinars and internet interactive events. So we can kick back, and what we're going to talk about today is how to capitalize on earnings season uncertainty and volatility. And I'm going to go through a lot of kind of really cool, low risk option strategies. So again, thank you for being here. And we've got earnings actually starting to kick off officially this week. We're going to have the banks kicking off, JP Morgan, et cetera. So this is the perfect time to kind of introduce or show you some of the strategies that you can use or incorporate to trade these kind of earning events. So a lot of times you get stuck on the sidelines because of all the volatility, not knowing what to do. So hopefully this will show you a lot of different things and different ways you can trade. So a little background on myself. I started my trading journey back in the mid 80s with a company called Coastal Corporation. They, at that time they had a training program that would actually bring you in if you got into it and, teach you how to trade crude oil and oil products. So they were a very large integrated oil company out of Houston. So got into that program, spent a couple months down at the refinery in Corpus Christi, Texas, learning kind of the oil process, bringing in crude, processing it through the distillation towers, and then got into the shipping part of the company, chartering ships and scheduling things like that. Finally got onto the cargo side, and that's where everything really changed. So, went out to sent me out to Singapore for about a couple of years, and that was a really great experience. Learned how to trade all the different Asian products and jet fuel, fuel oil, the Asian crudes, and then got a really great opportunity to go to work for a company called Trans World Oil. So that was kind of in the mid 80s. And at that time, they were the largest oil trading company in the world. It was Trans World, Fibro, and Mark Rich. So spent about 17 years there. And we traded everything. We were big on the energy side, but we eventually got into, all the Forex futures, name it, we were trading it. So about 16 years out in Bermuda, that's corporate office, and then ran the international trading desk out of Bermuda for about 10. So that's where, really started getting to options back, at Trans World. We started doing options, all kinds of option structures on crude oil and things like that. So never looked back. So just a little brief background on myself. And so that being said, let us get started. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So have you noticed how earnings can be horrendous and the stock goes up, or you have earnings that are, off the chart fantastic? You think, wow, what blowout earnings are those, that are coming out, and then the stock tanks. So this is what I call the earnings confusion. So it's this company, let's say you have a company, when they have an earnings conference call scheduled, the week of an earnings release or that day, many times there's going to be a lot of speculation, not only into the accuracy of their projected earnings per share, but also other factors. Maybe they're going to be doing layoffs, maybe they're going to buy another company, things that you weren't aware of, and all of a sudden, these things are introduced to the public through their earnings schedule call. And so that really can, ratchet up the volatility. So it's this kind of uncertainty that really causes an increase in the volatility in the shares of the stock. And that's the big kind of diamond in the rough, is this temporary parabolic rise in the volatility that can spike option prices and also spike either the price of the stock either higher or lower. So this is the kind of stuff that we want to be aware of and take advantage of. Now, the tendency as traders, human beings, et cetera, start to or stay on the sidelines going into the days leading up to the earnings conference call. So, a lot of times you're just sitting on your hands wondering, okay, what's going to happen with, NVIDIA when they announce, or, Tesla or something like that. So all of a sudden, though, then, you'll see the call buyers coming in to swap out their long shares of the stock for call options, so they can still, participate in the rise should there be, the move higher, but they want to limit that potential downside risk. So they're going to, swap out shares a lot of times, buy calls to replace it, but still be able to, participate in any big move. Now, then additionally, you're going to have the put buyers coming in, forcing the options higher, option prices higher, as they try to protect their downside positions from any major downside movement. So it's all this concentrated option buying in many cases will, drastically expand the volatility levels of stocks as they head into their earnings release. So as an individual trader, we can take advantage of all this uncertainty and volatility in order to capture profits, no matter what the crazy earnings reactions are, if you just know the right setup. Now, step one, we want to identify and qualify a particular stock, and we're going to do this by looking at its past earnings performance, and so the probabilities of it heading into the a new earnings release. So we can look at that history and get kind of an idea of the probabilities or the different things that this specific stock may do. Then we want to look to find those stocks that have their earnings release also during a weekly option expiration, so we can take advantage of that really accelerated time decay, and we can either buy cheap options or we can sell and get the advantage of the accelerated time decay and implied volatility. So weeklies are very, very important in these kind of option strategies. And then step two, we want to look at that past performance. We want to see what has volatility done to a stock previously as it moves closer into its earnings release and even after that release. So we can kind of get an idea of maybe what we can do if there's some consistent pattern that happens to this specific stock. So then as a prepared trader, we'll look for that dramatic increase in the stock's volatility as it approaches its earnings release. And a lot of times you're going to see normally, stock implied volatility or volatility is normally, moves around 25 to 40%. But the week of its earnings release or earnings announcement or conference call, you're going to see the volatility can really spike. And so it can really move to extremes 2 to 3 times more than what its normal volatility is. So this is, really what makes a stock a potentially great profit opportunity. It's that volatility that, again, can normally double. And in some cases, you'll see it even go 3 times the norm. So here's an example. So here's like NVIDIA, which is a high implied volatility type stock. And this is really great. Look where it was trading. So this is back when it was trading back at $270, right? So NVIDIA on the 13th was going to be having its earnings release after the close. So that'd be like on a Thursday. And then you can see here how jacked up this implied volatility is going in to its earnings announcement. So you can see 1 day at expiration right here. And you can see the implied volatility for this weekly series is over 114%. Now, normally, NVIDIA's had kind of historic normal volatility of about 40, but now it's about 114. So that's about 3 times the normal implied volatility. So that's really being spiked up because of all the uncertainty that it's going, into the stock as it heads to that earnings release date, which would be Thursday after the close. So that's what we can look to take advantage of. So that's, it's trading at 270 going into the earnings, implied volatility of over 114%. And then you can see the day after the earnings release, that volatility collapses or crushes to the downside, but also you had a price spike of 7.5% up to 291. But you can see what happened to the implied volatility. So you can see it was 114 on this series, and then the next day collapsed back down to that normal volatility. And plus, it got a spike of 7.5% up. So there are a lot of different ways and opportunities that we can, take advantage of earnings just if you know what to do. So that's a really good example to illustrate that. So here it was on the chart, trading right there about 270. You can see the implied volatility here had been steadily increasing as it headed to that earnings date, the earnings release date right here. So it, moved up, and then after the release, we got a 7.5% spike up, but also a collapse in implied volatility. So that's kind of the normal thing you're going to see, an increase in implied volatility. The earnings are released, all that uncertainty comes out, and everything collapses. So that's what we want to try to take advantage of. So we can take advantage of that volatility collapse, or we can take advantage of price spikes up or down if you know the right option strategies to use. So it's for this reason, it's kind of essential to have a kind of a watch list of stocks that you can monitor closely to, due to the fact that they're not going to all kind of present you an equal opportunity type trade. Now, remember, the goal is we want to take advantage of that temporary rise in volatility, as well as we want to take advantage of, past earnings performance on specific stocks and looking for the probabilities of certain things repeating. So we want to look for these high probability stocks that tend to have a tendency of, kind of consistent, same kind of things happening. Now, there are three types of earnings cycles. So you can have a cycle where you trend into the earnings release. So, the price of the stock could either trend up or down into the earnings release. And then you're going to have what I call the earnings release type trade. So this is a non-directional trade that you would set up, taking advantage of that volatility collapse or price spikes up or down, or you're just not going to know which way, right? So it's going to be non-directional. And then the third type of cycle is a post-earnings trend. So after, the earnings release, a lot of times you're going to see us, certain stocks will keep the trending either up or down after that earnings release. So it offers you potentially three types of cycle trades that you can trade. So here's a really good example. CRM, basically on this one, had all three. So trade one would be, a trend into the earnings release date, and you're going to see volatility trending higher. So you can see here this blue line, the teal, you can see the implied volatility just consistently trending up, right? So just moving up right into that earnings date. But also we're going to see, in this one, we're seeing price trend. Okay, so a lot of times the typical situation is, or reaction is, that you will see a price trend into earnings. If we've had if we're in a good, stable to strong market, the tendency is for prices to trend into the earnings, with the market looking for, okay, earnings are going to be, stronger this go around. So a lot of times traders are going to try to get a head start to get ahead of it. But you're also, so number one, you're getting the trend in this example up, but you're also getting a trend, your implied volatility is moving higher. So as that happens, you get your price of the option goes higher, right? Because the price is going up, implied volatility goes up. So that also drives the price of your option up. So if you were to buy, say, back here, going into the earnings, into the series of that earnings release, say this next week or something like the 11 October, if you were to buy that series, you're going to get the benefit of the implied volatility moving up, price moving up. And so this can be a great opportunity to, buy into an earnings release. But you don't want to hold the trade into the release, because we don't know what's going to happen to price, okay? And plus, volatility is going to collapse. So the next type of opportunity is what is the non-directional trade to trade the earnings release. So this is where, you get that implied volatility moving higher, and then it gets up here, and then after the earnings release, after the, when it releases earnings, all that uncertainty is out of the market, and the price can either collapse up or down. And so we're going to take advantage of that, and we're going to take advantage of that volatility collapse with certain earnings strategies. So that's kind of the trade two that you could do. And then trade three is, a lot of times you'll get a post-earnings trend, a lot of times in the direction of the earnings. So let's say they had a pretty stable to strong earnings. You can see here CRM continuing to trend to the upside. Or it could be the other way around. If they had weak earnings, you might see a trend, post-trend develop to the downside. So, when we do have earnings, that's what you can be looking for, these three potential type of trade setups that you can, incorporate into your trading portfolio. Now, here's just another example of Nike. You can see the same thing. So every stock that has an earnings release, its implied volatility is going to always go up into that release date. So you can see here, Nike was trending down, but you can see that the implied volatility of it trending up. The earnings were released right here. The stock price collapses, implied volatility collapses. And here you can see, going into the earnings date right here, see the steady increase in the implied volatility. Earnings are released. What happens? In this situation, price spikes, but also implied volatility collapses. So this is always going to be the case. So we want to take advantage of that, and sometimes we want to take advantage of the price spikes that we can, get into a trade based on a spike up or down, and I'll show you how that can be done. But before I get moving too much further, in case any of you have to take off early for a football game or whatever it might be. I'm going to be doing a course actually starting this Wednesday, just on, how to capitalize on the earnings season uncertainty and volatility, and going in depth on these different option strategies that I'll kind of, go over today. So this is going to start this Wednesday, October the 9th. It'll be at 4 p.m. Eastern to 6 p.m. And then we'll follow up the next day, Thursday, the 10th, from 4 to 5. And then we'll finish Monday, the 14th. So if you'd like to join us on that, please do. Let me give you the special link here. 1 second. And use this link here. And this is going to give you a discount of 15% off, okay? So the normal course price for this will be $197, but if you use this payment link and use Earn 15, you're gonna get this course today for $167 plus all the different bonuses that come with it. And then if you want my package 2 that has my alert service, it's $597. You're gonna get my alerts for 4 months, plus my trading club membership for four months. But if you use the 15% off, you'll get this for $507. So let me make sure you understand how to do this. And then all you have to do is click on that link I gave you. Click there, and it's going to pull up this payment link that you can use. Let me show you that. So it'll pull up this course offer. Okay, so then come down here and you'll see promo code Earn 15. So just scroll down and you'll see kind of a brief summary of what you're going to get here. So you can see the course. It'll be a not a 5 hour, but 4+ hour course. $1,600. My time and everything put together. Now the normal price, when we go out after today, after this is over, the discount is $197. Now, along with this, I'm going to give you some other bonuses. You'll get my 4 hours earnings course. This was actually at 7 hours. The one I did prior to this, this was on all the different strategies. So you'll get that right away to start with. You're going to get bonus 2, start trading options today. It's a really good intermediate option course. You'll get 1 30-day trial membership to my trading club, which we'll talk about later, which is trading room, all kinds of good stuff there. We'll do a follow-up Q&A. You'll get another kind of a course on the Greeks. It's a kind of a short course on the option Greeks and how those are used in standard deviation. And then I'm going to throw in 3 different trade lists for trading stocks, the earning stocks, and these are screened in type of a list there. So if you want that, it's $197. But then you come down here and you just click on the buy link here, and then type in Earn 15 small cap. Make sure it's small cap, and that will give the discount to $167. So we get the course, live course, and all the different additional bonuses. Plus, you'll get everything on demand. So let's see if this is coming up. Okay, so here it is. Here's kind of the summary. Go down here to where it says promo code, and just put in EARN15. And then hit apply. Now, if you want my trading indicators, you can also add those, but just hit it apply, and you'll get it for the $167. Now, if you want the alert service to go with this is course package 2. This is my Elite Open and Close Trade Alert service. You can have this also for 15% off. So you can see the trade summary, just unaudited, going back. Since inception back in May 2018, we've had 788 trades closed out, 567 winners, 52 break even. Anyway, a winning trade rate of 79%. So really high winning percentage there. So you'll get this for the next 4 months. And it incorporates 4 or 5 different services or alerts that I send out. And then you'll also get 4 months to the trading club, which gives you, the trading, the trading room, Q&As, all that kind of stuff. So this is course package 2, which then gives you everything also in course package 1, all the bonuses, but then you have access to all 5 of my alert services for 4 months. So typically send out 8 to 12 stocks or ETFs over the course of the month. So these will be alerts like for breakout type trades, which could be credit spreads and debit spreads, or it could be a calendar diagonals, very selective butterfly and long condor trades we do a lot of, and then selective earnings trades, and then monthly penny type trades. So that's what you're going to get with the alert service. And this will all last for 4 months. And you can stop it, start it when you want. If you have to go out on vacation, you'll get my daily video market newsletter, access to my virtual trading room, and 60% off on anything on my website. So if you want to add that to it, just come down here, click on that one, and then also just put in earn 15 right here. Make sure it's small cap, hit apply, and there you go. All right, so just kind of wanted to cover that. We'll go back through that a little bit later, but I want to make sure I got that out there in case you do have to leave early. All right, so again, you'll get the regular course price is $197 today. If you use that promo link, $167. If you want the alerts with it, all 5 of the different alerts I sent out, it's $507 today. All right, so that's what you're going to get there. And one more thing to add to it. Now, sometimes a lot of people that are looking to buy one of these courses, they're like questioning, have I purchased this before, from you? So these are always new courses when I do it. So this is an all new course for this earnings strategies. So to see if you purchased this earnings course in the past, what you're going to do is just locate it on your personal Power Cycle Trading Account tab, like below. You just look at your tab under your PCT account, okay, and then look down here and you'll see what courses that you have. So you'll see if you did buy an earnings course in the past, you'll see it right there, so you'll know, and then you can go click on that and see when that was, etc. So I do this pretty much every 3 months, every quarter. We have a new earnings season, so I kind of update it for that. So just check down there to make sure. If you don't have it, then that's an easy way to do it. But you can see whatever course you may have in the past that you've done. So just that makes it easy, so you're not kind of scratching your head, hey, have I done this course before? All right, so if you have any questions, let us know on that. Yeah, it's always updated. Okay, so step 3, and we'll come back to that, and if you have any other questions, we'll spend some more time on the course, what you're going to get, what we'll cover. So step 3 then is what I do is I use what I call a pre-earnings kind of checklist, and this helps to kind of systematize the trade setup process, for making these kind of trading decisions and selection. I like to try to make things as systematic as possible, to kind of take your emotions out of your trading. So if you kind of have a checklist of things to do, it's going to help that, to do it over and over, to make it less, less reliant on your emotions and more kind of seamless. So what I look for then for this kind of high probability checklist is, first off, it has to have options, and typically weekly options with good option liquidity. All right, so we must also have good pre-earnings volatility. You don't want something that's totally flat with zero volatility, because then we don't have any price movement. So it has to have that. So in the course, I'll teach you how to go about and screen for this and what we look for. Now, also must have price movements. I do a number of different screens, but a couple of them is first thing I like to look for. I like to look for those stocks that have had a price movement of greater than 5%. Up or down over the last 3 to 4 cycles. Then I do another screen where I like to look for those specific stocks coming into their earnings release that have no more than a 7% move up or down. So what these 2 screens do is this then sets us up for the different strategies that we can use to take advantage of, say, a stock that has a potential for explosive moves up or down, or for stock that's kind of contained that doesn't really go anywhere. So then we can take advantage of that with certain strategies. And typically I'll look at this over the last 4 earnings cycles to kind of look for a pattern. Now we can go back further than that, but I kind of tend to stick with 4 cycles. So I'll show you some examples of that. And then I also kind of put a minimum price of $30 on up. So if you get below $30, there's just not enough price movement that makes it worthwhile. So that's kind of part of the screen, 30 bucks and higher, and these, potential moves of greater than 5% or no more than, 5 to 7% there. So that's part of the screen that I'll always do. The next thing I do is then calculate. We want to calculate the implied move of that specific stock the day that it's going to be having its earnings announcement. So by doing that, then we can look at the expected targets up or down, and then we can look at backing into, what strategy we want to look at and look at the risk reward of that strategy. So this is all done, and then we do this with our, price earnings target analysis, which is using Fibonacci, some other things to, kind of map out where it potentially could go up and down. And then select the appropriate weekly option strategy, entry plan, and what the exit plan is. So these are kind of the steps involved in each and every trade. Now, one thing that I always like to look at is really drill down into the data. Okay, so looking what I call the data analysis. So, for example, on Roku, we want to see, okay, what did this stock do in the past, and does it have any kind of consistency to it going forward? So here's an example. So Roku, and this one was going to have its earnings on the 7th, and then the expiration was the next day. So again, this was one that was going to have the earnings on a Thursday, so one day to expiration, and then the expiration was the day after, all right, on Friday. So again, here's one that was high implied volatility going in. So here it was over 212%, that series, okay, one day left. And you can see its normal implied volatility is more like around 70. So this was like 3 times the normal implied volatility. So it's really jacked up. So, we could take advantage of a volatility crush, or we could take advantage of maybe a big price spike up or down because of this huge volatility, which is telling us that Roku has a tendency to be very volatile and have volatile price movements up or down. So what I like to do next is then, okay, well, let's see, what has Roku done in the past? Does it consistently have huge moves? So first off, though, then the next day, you can see the volatility crush. Here it goes again, it was up to over 200% implied volatility. The next day, collapsed back to what is normally the implied volatility. But also, you can see that price was at $137, going out the day of its earnings release. And the next day, it had dropped down to 127. So it dropped 7% down. So we had a volatility collapse plus a collapse in price of 7%. So a lot of different things to do on this specific trade. So you can see the data going back just to kind of, support potentially what Roku does. So here's the implied volatility movement history. So you can see here going back about 1, 2, 3, about 7 cycles. You can see historically it has huge implied volatility. Here's the expected move, over 10% up or down, 11% up or down, over 14% up or down. So you can see the tendency for Roku is for big price spikes, movements after its earnings release, either up or down of close to 12, 13%. And then what I like to do, okay, then, but what did it actually do? So then, we can run a screen here and look at the data going back. Okay, here's the day after the release. All right, so what did it actually do? Here it closed down almost 7%. The cycle before it closed down almost 8%, closed down 6%, 16%, up 20, up 28, 25. So this tells us, man, Roku can have explosive moves up or down. So that will then tell us, okay, well, what we could do and what we don't want to do based on, this history. All right, so that's the next thing. So what does the history tell us? And so this one tells us, man, this sucker can have huge moves. All right, so then just kind of putting it back down to a table, you can really see it really stands out. So here it goes back 8 cycles just to show you. And here's where the closing price going into the earnings release, and here's that implied move history. So plus or minus 10% up, almost 12%, 14, 14, 15, almost 12. All right, so the average, the expected move range over the last 8 cycles, Roku's been moving, the history says 14.5% up. But here's what it actually did. So you can see the actual earnings release after the 1 day later. On this one, it was down almost 7%. The cycle before it was down almost 8%, down 6%, 16, up 20, 28, 25, 22. So actually, when you add that, average that up, you can see that it actually has potentially bigger moves than its expected move history. So this really tells you what to do and not to do. Okay, so what you don't want to be doing on this one is selling volatility collapse, because you could easily get crushed and have it go straight through your short strike. Okay, but what you could do is play a trade for a big spike either up or down that's non-directional. So this is one that you can do from time to time on the right stock. So here's the one, we'll look at that later and I'll show you what that was. So the step 4 is the power of weekly options. Now I like to use the weeklies for all these types of earnings trades to take advantage of the two really key things for an option and their price, which is going to be the time component, time value, and then the other component of price is the implied volatility, which we know can get spiked up. So we really want to take advantage of that. Now the combination of these two, pricing components of your option, when used correctly, this is really what can help you create, kind of low cost, very defined risk, kind of a trading formula to use to generate high returns in a very short period of time. So with the right trade setup in the right strategy, it's kind of turns out to be kind of lightning in a bottle on some of these trades. You can just, what you want to do is bottle it up and do it each and every time. So kind of like lightning in a bottle, when you see something that really performs well, let's just do this over and over and see if we can bottle it, right? So that's kind of a term sometimes used in trading. Now, then if you know which weekly option strategy to use for the earnings trade, how to construct it, and then when to trade it, then these weeklies can really produce an exceptional fast profits due to the incredible leverage you're going to get, making them the perfect trading vehicle for your earnings types trades. So then how is this done? How do you know which one to do? So I do what I call comparative option strategy analysis. So when constructing the earnings option trade, I look to the risk reward or your return on your capital that you're putting up at risk for that trade between the various strategies that you can use, and then compare that risk reward and pick the best strategy based on that risk reward, based on your kind of risk profile for your trading goals. So there are going to be times then when you can actually use more than just one strategy. So this is the thing that I do. Going to look at the various different strategies that I'll show you, and then compare and look at the risk reward, and then you select the best one suited, you think, for your risk profile or tolerance, and then for the environment you're trading. So then step 5, what are the strategies and how do they work? Now there are 5 different strategies that I'll use, okay? And these can capture profits from the extreme price volatility that surrounds the earnings release, or they can also capture the profits from the big price spikes that may happen up or down. Now certain ones are best for certain stocks based on what they've done in the past. So the trade or strategies are basically non-directional earning strategies. Okay, so they're kind of categorized 5 different ones. So one we can do and use is called the short iron condor spread. So this is actually a debit spread created for big price spikes. So if there's a stock that you look at its history and it has a tendency, like Roku or Nvidia, those examples, to have big price spikes up or down, we can do this strategy. Now, the other ones are more for volatility collapse, that we know volatility is going to collapse. So the other one we can look at is what we call the long iron condor spread. So this is actually a credit spread that's going to take advantage of that high implied volatility that we're going to sell and look for it to collapse, so volatility collapse. The third one that we can use is what we call the long iron butterfly, also a credit spread type strategy, taking advantage of that high implied volatility in the collapse that it has after the earnings release. Now the next one is one of my favorites, what I call the double lightning. So this is actually a debit spread, but it's also what I call a flexibility trade, because it's going to take advantage of selling that volatility, the high implied volatility, in getting the volatility crush after the earnings release, but we can also have this set up if there's a post-earnings trend, we can use this strategy to take advantage of that. So this is kind of like a favorite, okay? And then the other strategy I'll talk about is what we call the earnings pairs trading strategy. So this is a kind of a market neutral long short to use for any kind of post-trend after the earnings release. So these are the 5 strategies that I'll look at, and then you can, once you understand how to use them, we can then back in and we can look at the risk reward on the various ones and then select the one that's best suited. Sometimes there may be, 1 or 2 that you want to use. So with today, I'll just kind of give you an overview of what they look like so you can get an idea. So the first one we'll take a look at is the volatility crush. So here's your earnings strategy to take advantage of that volatility crush or collapse. So this is the long iron condor credit spread. So you're going to use this one. It's, basically it's defined risk. So we always want everything defined risk. We're not going to be selling anything naked because we want it defined. We don't want any unlimited risk up or down. So it's basically a non-directional earnings release strategy. So I use a screen that I use to really help to increase the winning probability. So it's a really good filter that I use for this. So this takes advantage of pre-earnings high implied volatility, and this takes advantage of selling that time in high volatility. So the profit comes from that volatility collapse, and these are short, very short duration. It could be 1 to 3 days, kind of 3 days at the max. So this is just playing that volatility spike and the volatility collapse that we get from an earnings release. All right, so here's an example of one on Apple that we had done. All right, so here's just kind of going through, you can see the implied volatility here. So here was Apple trading at 165.79. The expiration was going to be the very next day. So this was on a Thursday, expiration the next day. Now the implied expected move was going into this one day was that Apple could go up for 4.21% or down. Now that's one standard deviation, but a lot of times stocks can move more than that, right? Now you can see that here on the implied volatility, we were going to be looking at the 175 strike right here. So you can see that strike there going into the earnings had a implied volatility of over 61%. And the 157 put that we're going to be looking at had an implied volatility of over 88. So very, very high implied volatility. So that's what we're looking for, right? And then we're looking for that collapse to take advantage of. So you can see that in that option chain right there. Now the next day, you can see that the volatility, you can see the price here was 165.79, and then the next day the price had shot up to 173.57, but implied volatility here had collapsed. So that's what we're looking for to take advantage of, right? So prior to that day, it was up to about 60 or 70, and then it collapses there. So that's what we want to take advantage of, that volatility collapse. All right, so here was the trade setup. So going into this trade, no, the earnings data is not that I use is not on TOS. I'll talk about that a little bit more, but you'll get the data, in the course and how to use it. That's a good question. So the question was, is the earnings data, analysis that I'm using on TOS, and it's not. All right, but the course, that's a big part of the course too, is to go over the data, how it's used, how to set up the screens. Okay. Now here's going back to Apple. Here it was going into the, that day of the earnings. So this was put on before the close, and it, it's trading right around, $166, and then it was set for the next day. So the expected move going into the close was 4.2% up or down, and the next day it though closed up 4.6, so barely moved. So this was perfect for this credit spread to take advantage of that volatility collapse right there. All right, so you can see the spike here. The price barely moved. I mean, it went up to about 4.6%, and that was right in line with the expected move right here. But the volatility collapsed. The earnings uncertainty was out. Boom, no more uncertainty. Everything goes out of it, just like popping a balloon. So that's what we're looking to take advantage of in a lot of these types of trades. So here was the kind of the profile of the potential here. So this was going to be doing an iron condor credit spread and this would be selling like the 175 call by the 177.5, and then selling the 157.5 put by the 155. So we're doing this type trade here to take advantage of the collapse and having price not move, okay? So by setting this up, we were able to bring in a credit of $60. Now the risk is your difference between the spread, which is $2.50, less your credit or your potential profit. So the risk on this trade was $190. So this is, these types of trades are what we call a negative risk ratio, but they're based on probabilities. So the probability for this trade was, it looked good over the earnings history that doesn't move much. So we want to take advantage of that high implied volatility, and that's a typical return. So this ended up, with a 32% return. So that's one way to trade it. So here's what it looked like, the next day with the iron condor. So here's the trade setup, put on the day before prior to the close. So, short that call credit spread there, short the bull put credit spread here, and we're taking advantage of that implied volatility spike that we know collapses after the earnings release. And so if it goes out in between our two spreads, that's going to be our max profit. So it went out right there, and you can see it went from the credit received on the call side was 25 bucks. We kept that 25 bucks there, profit plus the put spread collapsed to 0, so 35 bucks there. So that was our profit of 60. All right, so that's one way that you can take advantage of, doing these. But the key is the selection process, and what I call, I've got a very selective filter that I use to kind of really look for the ones that are the high probability. Because if you just do this kind of trade on everything, thinking everything is going to have a volatility collapse, which it does, and think you're going to trade from that, where you're going to, over the long haul, get smoked pretty bad, because there are a lot of stocks that will have bigger moves than the expected move, right? So that's what you want to really be screening for and understand how to do. And that's what the course is all about. Now, the next one that we could use, if we think something's going to have the potential for big explosive price spikes, this is the one that we can use on that. So iron condor debit spread. So again, defined risk, it's a debit spread. So your risk is your debit paid. Also structured for non-directional, takes advantage of the earnings release price spikes, explosive price spikes, set up for 1 to 3 days, kind of the max duration on this. So here's one that we had done. This was on CRM, and this was looking for a big potential price spike, okay? And so the expected move going into the trade was on the 29th, it was trading at 230.35, expiration, 12/1. So the expected move going into the trade was almost 5% up or down. But look where it did. It closed up 12.87. Huge spike, right? Right there. So you can see the implied volatility came off, but this thing spiked up. So if you were selling implied volatility here, you would have been just crushed, because it blew right through your, 5% up. This was, almost 2.5%, the normal range right there. So we can take advantage of this, though. At this specific stock, which it did have a tendency for these kind of big moves. So here's one, the kind of setup that was used. So it was going into trading 230, basically expected to move to 4.88 up. So set the upside target for it needed to move 3%, at least 3% move up or 4% move down. So set this structure up. So we're going to be long the 235, 237.5 call debit spread, long the 222.5, 220 put debit spread. Our total risk, you can see it's a $2.50 wide spread, 250 bucks, right? The total risk, our potential profits, 82. If it blows either up or down this amount, we'd make 82. So the difference is the potential risk of 168. So the potential profit is $82 per spread. Risk is 168, again, negative risk ratio, but this is done as a probability trade because of looking at past performance of these specific stocks, what they do. So 49% return. So these are trades, to get you off the sideline and take advantage of, what these, earnings can offer. So that's what it looked like. So you can see then what it did going out. So we had this long call debit spread here. long put debit spread here. So we didn't care which way it went, up or down, but we wanted it needed to move at least 3% up or 4% down the way this was structured. Now this was up 12%, so it was way out here. So this one was max profit. You can see it went from, the spread blew out. So it went from, 84 was the call side debit spread, and this thing blew to 250 right there, right? That spread blew out to 250. So this was then up $218 on that side. And, the put debit spread lost 84. So we don't care. So that lost 84. So net though was a profit of 82 bucks. All right, non-directional. We didn't care if it goes up, it goes down. We're just playing for a big price spike based on what it's done in the past, based on that earnings history. And that's what we're going to really dive into deeply into the course that will be this next Wednesday. All right, so that's that. Now this next one is kind of what I've termed my go-to strategy. So this is due to the risk to rewards are super low on this, and it offers that flexibility of staying with the trade if you want to. So I call it the double lightning earnings spread. So it's basically broken down as a double calendar. It's a really cool structure. So again, but this thing is super low risk. So when you do that comparative option analysis, comparing, say, the iron condor debit spread, credit spread, and you compare this one, you're going to usually always want to do this because it's the lowest risk with the potential highest return. So low risk, non-directional earnings release strategy, structured for low defined risk, takes advantage of that pre-earnings high implied volatility spike. You're selling time and volatility in it. The profit comes from that volatility collapse, but also allows, if you want to stay with the trade for any post-earnings trend. Trade duration on these are typically 1 day, maybe up to a week. Positive theta, no time decay, and these are done for a debit. So, what really sets the strategy apart from all the others that you can use is that it's selling volatility, but we can also then adjust it if we want to into a directional trade after the earnings release. And this then provides you even a bigger potential for bigger profits from that post-earnings directional move. So I started, kind of put this together, started looking at it and using it back in 2020, and then added it to the alert service as far as the earnings trade. So we've had great results, and I'm very, very selective on which stocks to do. And that's also what we'll do, in the selection process in the course. We'll show you how to screen for this, type trade and the others as well. But since using this, these are, again, very, very selective earnings trades. So if you do the alert service, which gives you 5 different alerts that I send out, this will be one of that you could take if you want. So I started this earnings alert trades that I sent out back in June of 2019, and through Friday, the summary, these are unaudited. We've had 127 of these earnings trades. These are specifically for earnings closed out. 91 are winners, 16 break even, 20 losers. So really high winning percentage. And that comes from the selection process and the screening that I do of these trades. So that's going to be the big part of the course that you're going to, if you sign up today, this is a big part of it. It's the selection process, and then, which strategy to put with it based on, the tendencies of that specific stock that you're looking at. All right, so here's a really great example. This is one that we had done on STZ, okay? Constellation brand. So non-directional, low risk, volatility collapse strategy. All right, so again, just kind of going through the steps, going back, looking at the history. You can see here's just some of the data that we're going to look at. Expected move history, tendency going into the release, 3.5% up or down, 3.66 up or down, 3.37. So this one has a tendency to just move, around 3.5% up or down. So, not a big, huge spike up or down. So that's good. That's kind of what we're looking for in this strategy. And then you can see, well, what did it actually do? So after the day after earnings, you can see here, in this one, it was up 2, down 3, flat, up 1.44. So it tends to kind of hang around that expected move range. So this one looks, good probability trade for this strategy. So here's what it looked like on the chart. It was just kind of hanging here. The expected move going in was for it to move 3.5% up or down into that earnings release one day later. And so this was going to be set this for 3%. All right, so this was doing a double lightning or double calendar. So you can see here going in to the trade, here it was on the 5th, before the open was going to be when the earnings release. So this was set up the day before because the opening was going to be the next day would be when the earnings came out. So it was trading at 242.33 and the expiration was for the next day. So you can see that one day, this had the history here, implied volatility was up 86%. And normal implied volatilities, on this one is about, 25%. So you're about 3 times the normal implied volatility. So really spiked up. So here's how we could take advantage of it with this type of structure. Get rid of that drawing pin. So the next day, you can see now, here it went from 242.33. The next day, it's at 247.50-ish. And look at the implied volatility. It collapsed back down to the norm, all right, around that 20.25. And price didn't move much. So here was the trade. So we did this as a setup for a double calendar, targeting 3% up, targeting 3% down, non-directional. We didn't care which one. We're just looking for it to move 3% up or 3% down. So here was the trade. We did the 247.5 call calendar right here. So you can see long the 12 Jan, short the 5 Jan. So that's the spread between the two series. And then did the put side, 235, all right? Now this total risk on this trade for both spreads, we had $75 debit cost for the call calendar, $75 for the put calendar. So our total risk was $150. Now these are really forgiving too. So they're hard to lose the whole amount just based on the structure. So your break evens are really wide. On this one, your break even up was like 4%. So it'd have to explode up 4%. What it'd have to do is gap up over 4% and never come back, or gap down 5% and never come back. That rarely happens on any of these if you screen it right. So the break even, is it's a very hard trade to lose on. So so you can see this one was actually worked out perfect because we hit that 3% up on the call side. So you can see, let me erase this for you real quick. So the spread went from 75. Okay, so we had a total cost of 150. So you can see the spread blew to 293 for the call side, 38 for the put side. So that spread had increased the total spread for $330 less the cost of 150. So this was up $180, 120% return. Now think about that versus those other type of trades, which were negative ratio trades. They were making maybe 30%, maybe a good one 45%. So you can see how these are just kind of the go-to. So you can see it went from $75, the call side right there, to 293. So there was the profit on that. Okay. And then you can see the put side, lost a little, but not much. So it was on at 75 and it was down at 38. So that was the loss there. So this, you can see there here, your trade here on STZ, you made $218 on the call side. You lost 38 on the put side. Net, you made that $150. All right, so that's how that works. And then if we thought it was going to keep going, we could just stay long the 12 Jan. We could close out the 5 Jan, stay long, and keep trading it to the upside. So kind of, also kind of flexibility. So here's just another one. This was one that we did on CL to take advantage. But now look how cheap this one is. This is going to just blow you away. These things can be super cheap. So here's expected move history, not looking for big moves. Here's what it actually did, about 2% up or down, over the last 4. So this is kind of what we're looking for. So set this one up as a double calendar. And here's where it was trading, expected move 2.83% up. set the trade up for 2.5% move up, not much, take advantage of volatility collapse. And you can see here going into the trade that 83 strike was 46 implied volatility. The day after, that 83 strike was 14, so taking advantage of that. So look how cheap this thing is. So this trade was set up for $17. That's their total debit cost risk. So the expected move was 2.83%, set at 2.5% up or down. Break even way up 4%, break even down. So hard to lose. And if you did lose, you're going to lose 17 bucks. So this trade though ended up making 36 bucks per spread. Doesn't seem like a lot, but when you look at it on your risk of 17, that's over 200% return in one day. So you can see the spread cost was 11 on the call side, plus 6 on the put side, 17, and then the spread went to 53. That spread blew to 53, cost there 36. So from 11 to 53, 6 to 0. So you can see, so these are super cool trades, and if you want to stay long or short, you can do it based on the structure. So this is the what I call the double lightning. All right, so that's a big one that we'll really be focusing on, you know, in the course. So yeah, here again, here, use this link here, Charlie. Make sure that you have that. All right, yeah, just click on that, powercycletrading.com/special, and then use small cap EARN 15 to get that 15% off today. And we'll go back through that here in a bit. Okay, 1 second. All right. Now that is, you know, a really great strategy, and you know, like I said, kind of the go-to. Now the next one that we can use is, you know, what we call, or I call the earnings pairs trading strategy. So a market neutral for a post-earnings trend. This is a really cool way to trade a post-earnings trend. So by using pairs, now pairs trading or spread trading is a market neutral strategy, trade strategy, and that's why hedge funds are called hedge funds, because they're long short. So this is a way to do it. So it can be used for trading a post-earnings trend move on a stock after its earnings release. So by trading a pair or spreads, this is really going to help you to mitigate overall directional market risk in the market. Yeah, that double lightning is definitely cool. Okay, now by simultaneously taking opposite positions on a related security, this then allows you to reduce that exposure to the broad market movement. So, you know, a pairs trade then is going to then be equally likely to profit whether the market you trade goes up, down, or sideways. It doesn't matter. So you're just playing the difference, the spread difference between two securities. Okay, so you're going to learn how to do these trades in the course, though, using synthetic options to make it super cheap and take advantage of that leverage that the options give versus, you know, shares. So think about this. So let's say you wanted to pair a trade, and I'll show you an example, maybe Apple versus QQQ. So Apple is very correlated to the ETF QQQ, right? Or it could be XLK or something like that. But let's say you think, you know, Apple had earnings and they weren't really good, and so it looks weak relative to QQQ. So you could do a spread or a pairs trade where you could be long QQQ, which goes up faster, and short Apple, which is not going up as fast. So you could be that pairs trade. And even if the market's going down, QQQ stands steady, but you know, the market's falling down and Apple's falling more. So you have that spread there. QQQ going up more than Apple. Okay, you're playing that spread. Or the long rises, but the short goes sideways, so that QQQ could be going up. Apple could just be flat, and we've seen that Apple just been flat lately, but that spread between the two, the QQQ, has been rising. So we can do this with an earnings type trade. Or say QQQ goes sideways, but Apple declines. So QQQ goes sideways, but Apple is weaker and declines, so that spread widens, right? Or Apple or QQQ, let's say, goes down slowly, but Apple goes down a lot faster. Okay, so that spread widens. Or Apple or QQQ goes up, Apple goes down. So you've got 5 different ways that you can make money versus if you think Apple's going to be weak and go down, you'd have to go short Apple. But then, maybe it goes up because of the broad markets. But this way you can short it, or go long it without having to take that directional risk, because it's going to be neutralized with an offsetting security that's correlated with it. All right, so pairs trades, then what we do is we can structure the long short using a synthetic long for the option for the stock security that we want long, and we can structure synthetic short options set up for the stock or security we want short. So in this one, we could be long QQQ options and short Apple, okay? But there's a certain way to do it so you're not risking your theta, okay? So this is using a synthetic long short to do the actual pairs trade. So you're going to learn how to do that in the course as well. So here's an example. So you can see here, this was Apple on the 4th of May. It had good earnings and it just started trending up. See that beautiful trend up? And then here's just another example. On the 3rd of August, it had bad earnings and look, just started trending down. So here's the spread between it. So if you wanted to do a correlated trade using QQQ versus Apple, which has a high correlation of 70% or better, here's one way you could do it to be neutral to the broad market risk. If I can get the slide to turn. Hold on. All right, so here's the actual spread. All right, so this is a spread between QQQ long and Apple short, just the shares, okay? So this would be like one share, okay? So look where it went. So here's being long QQQ, short Apple. So right here on the 4th of May, this spread was at $152. So that's QQQ was $152 per share higher than Apple, okay? Now look what happened. It started, look at that, started moving up because Apple was weak going down, but QQQ was not as weak. And it didn't matter if the market was going up or down. QQQ was going to be stronger than Apple. So that spread between the two then went from 152 and on the 18th of July was now at 191. So right here. All right, so look at that movement. So that went from, 190, the spread blew out in that situation to $191 QQQ over Apple. And if you'd bought it when it was right here, it was at that point 152 over. QQQ was $152 per share over. Now it went to 191. So that's an increase of, what is that, $39 per share. Okay. Now, if we're going to do, if we do synthetic options, one option contract's equivalent to 100 shares, right? So if you did this long QQQ, one option contract, short Apple, one option contract, and you made $39 per share on 100, one option contract's equivalent to 100 shares, that would have been a movement or an increase or profit of $3,900 for one option pairs trade synthetically, right? So that's the cool thing about that. And that's what you're going to learn if you're, sign up for the course. Now, here's the next one. So here on the 3rd of August, it was trading here at 183, right there. Now you can see on the 14th, now it was popped up to 201. So here's another one. So if you did that one, it went from 183 to 201 over, and you start at 183 over. Now this one, if you did one option, one share, you would have been up $18 per share. If you did this with a synthetic option structure, that'd be equivalent to 100 shares, you're up $1,800 with no overnight directional risk. So if the market's crushing down or whatever, that structure, QQQ in this example was stronger than Apple. So that's a great way if you want to take advantage of a post-earnings trend, or you can use these types of trades for anything, basically. Now here's just one more example. Here was Nike. It had earnings here on the 29th, and it just, bad earnings, goes down. And then it had earnings here on the 28th, good earnings, and it goes up. Now this one was a spread that was dollar adjusted for the make it equal weighted on a dollar. So you're going to learn how to do that. All right, so it's not 1-to-1. This one is going to be kind of a ratio. We're going to make it dollar equivalent. All right, so in this example here, you can see starting out, it was here trading at, you can see this, it was trading at, Nike was $72 over SPY right there. Then it had bad earnings. And so look at the spread. It started to collapse, started going down. So it went down and it went all the way down here to, now at this point, it was down to 14 under right there. Now Nike was trading at $14 under, okay? So if you'd gone short Nike, long SPY, or the other way around, on this trade, you would have been up here one share. Well, on this ratio, you would have been up $86 per spread, okay, times 100 because you have one option contract. If you did one option contract, this one you'd be up $8,600. That's if you did one. If you did 10, you can see the difference, right? So that's taking advantage of that spread weakening. So it went from 72 over, Nike was 72 under, to now it's 14 under. So an increase of $86 or $8,600 per option spread. All right, so and then right here, you can see the other way, this was trading at 2.5 under, and then Nike had that good earnings, and so it started trending up. And you can see here, it got up to close to right here, it got up to 75 over. All right, so there you've got, 75, it went to 75 over. You started when it was 2.5 under, okay? So you have a total spread increase of $77.50 per option spread. That would be $7,750. All right, so these are really cool, and you're going to learn then, also how to do that if you'd like to take advantage of a post-earnings trend move. So it just kind of covers, all the different ways that you can skin the cat with this type of, earnings season. Now, will every trade be a winning trade? No, but what works is using a systematic approach then for screening and finding these kind of high probability trades. Yeah, here, Joanne, here's the link again. So use this link here, and then use the small cap EARN15, and you'll get that 15% off today. So yeah, use that now. They won't all be winners, but we try to really screen it so these are high probability trades, right? So you can see the results we've had running about 84%. So just don't jump out and do everything, but just really screen it. And that's the big part of what you're going to learn in the course. So let's take a look at how you can start profiting from this upcoming high volatility earnings season using these weekly options and more. So we'll get a little bit more detail of what I'll start this next Wednesday, the 9th of October. We'll start at 4 p.m. Eastern, 3 Central, till 6, and then we'll the next day we'll start at 4 p.m. to 5. So here we are, 3 hours, and then we're going to finish up on Monday, the following Monday, the 14th, and we'll also have a dedicated Q&A for it the next day after that. So there'll be plenty of time for you to learn everything and ask questions. So this course is $197. But then I've got a lot of different things that I throw in with it. So, but the course is $197, plus there are 6 enrollment bonuses you'll get. And so it's real easy. You can use this powercycletrading.com/1earn, or again, just use this link I gave you, powercycletrading.com/special. Use that link, click on that, and this will show you everything you're going to get, and then you use that earn 15 and you'll get the course and all the goodies. Let me pull that up here. Here we go. Okay, so here's what you're going to get. So if you use that link and use your earn 15, you'll get everything here today for $167. That's like 89% off of that course price of $1,600. plus you're going to get the bonus, my on-demand earnings course. This was, turned out was 7 hours. Great course, so you get that right away. You'll then also get 30-day trial membership to my trading club. If you stay on after that, it's $97. You can start this when you want after the course, whatever. Then I also will give you my Start Trading Options Today, kind of intermediate beginners option course. You'll get that. We'll do a follow-up Q&A with it, and then another short course on the Greeks, delta, gamma, theta, and standard deviation, and then my 3 updated list of stocks, my watch list of stocks that we'll be looking for these earnings trades. Yeah, so these are so if so the question is, do you have a live trading day where you can show people in real time what these trades look like? Yeah. So with the course package 1 or course package 2, you're going to get access to the live trading room. Okay. So let's see here. Well, anyway, you're going to get access to my trading room, right? So it's open every day from 9:30 Eastern, 8:30 Central to 9:30. Okay, so you come in there. We're going to do an earnings trade. A lot of times we'll go over the trade in the trade room, so you'll see exactly how to set it up. And if there's one that you're looking at, a lot of members come in and say, "Hey, can we look at this XYZ? It's having earnings tomorrow. Let's take a look what it looks like. Should we maybe do this? And how would we do it?" So I'll go through and say, in my opinion, no, doesn't look like a good earnings trade because of this, this, and this. Oh, no, this looks like a potentially good one, and here's how we should do it. All right, so these are all done. If you do come in the trading room, that's where you're going to see it, or the alerts when they're sent out, and then we can go through the alerts. Okay. No. So if it's an earnings trade, it'll say earnings. It'll say new earnings trade. Okay. NVIDIA is not an earnings trade. So we did a trade on NVIDIA, and that was not, it'll specifically say if it's an earnings trade. Okay. So it'll specifically say, I'll show you an example. So here's, okay, here, this thing will pull up here, Joanne, here's the link again. This thing is acting really bad here. Again, so just go here to that link that you should be able to click on it. Or if you don't, you can just put it in your browser, powercycletrading.com/special. Scroll on down, click buy now, and you'll get the discount today. And just put in that earn 15 right here. And then hit apply. Okay, and then, or if you want the alert service package, which I would highly recommend, because then you'll get all the earnings trades, anything that I sent out. Go to this one, and you'll get, this is $597, but today, if you do sign up here today, you'll get this for $507. So this will be everything in course package 1, all the goodies, plus then the next 4 months, the alerts plus 4 months of my trading club, which gives you access to my trading room and a lot more. So we'll go through that here in a minute. Okay, so that's earn 15, just put that in. There you go. And yeah, so when I send out alert for the earnings, it will say new earnings trade on JP Morgan, NVIDIA, something like that, right? Let me see if I can find one real quick here. So for example, we did pulling up Friday, we did an earnings trade, not an earnings trade, we did a trade on NVIDIA, but it doesn't say anything about earnings, right? It just says NVIDIA long. So if it's an earnings trade, I'll designate it. So here's the trade we did right going into the close. So you can see here it says new NVIDIA long. Now, if this had been an earnings, it would have said new NVIDIA long, new NVIDIA earnings trade. Okay, so it'll specify it. So this was just a NVIDIA long. So it's trading at 124, et cetera. So this is doing a long condor. And we use Telegram, which sends these trades out within seconds. So it's really good. It's a free app that we use for that. All right, so that, yeah, that's a good question. And if you have any questions, let me know. If I miss a question too, just keep it in there and because they scroll off. So you'll get this today for $167. Now, if you want the course package 2, that's going to give you my alert service. And I have 5 specific different types of alerts that I send out. And so you'll have that for the next 4 months. And so you can stop and start whenever you want if you go on vacation or have to take off for work. Plus you get 4 months of my trading club. Now, we'll go through what that is. Now, so the types of trades that might go out would be selective earnings type trades, but it'll say an earnings trade, or it'll be a butterfly. It could be a butterfly long condor. So the one that was sent out Friday at the close was NVIDIA, a long condor, or it could be a calendar diagonal, or it might be a monthly type of penny trade, which we use butterflies or calendars, and this will specifically say that. Or it could be just a breakout. We're looking at a move up or down. So we did a breakout trade also this week on USO. So, you know, we can go through that and show you. So those are the kind of different ones that will be sent out. So just depending on what the market's given us, it could be a butterfly, or I might say it could be a better trade for a calendar, et cetera. So, but 5 different types of trades that I send out. So with this, you'll get this for the next 4 months plus 4 months of the trading club. So the 5 different ones for today, if you sign up, it's 507. Now, when I send out these trades, I always give you an option trade that you can use. A lot of members just do their own thing. They just, you know, want the trade. And if, like, say, NVIDIA, they may just go long the stock, maybe they go long calls, whatever. But I'll also always give you an option trade, okay, and a guide for it. So the trade setup, I do a video review of the trade after the close that day. Trades are listed and archived. And then we have every week, we'll do a weekly Q&A. And this will also be recorded, so you have that for the next 4 months. And then I do a video newsletter, you know, every day after the close, what the market's doing, what we're looking for. But here's where you get really a great access to the virtual trading room. And so this is where you can come in and ask questions on anything you're doing or problems with the trade, or if we're doing an earnings trade or whatever, you'll see how that's structured in the trading room. And so this is open each and every day during the week from 8:30 Central to 9:30. And then anything on my website, any course or software, you'll get a 60% discount as a member. So you'll have that for the next 4 months. So really great package there. We'll go through some other examples here in a second. All right. So the trade alert service since inception, adding all the 5 different alerts. Started the first one back in 2018, May 2018 through yesterday. These are unaudited, just a summary. We've had 788 trades closed out, 567 winners, 52 break even, 169 losers. So high winning percentage of trades, just, you know, really shooting for a high winning percentage with low risk type trades. That's kind of my goal is to shoot for. And here, just again, here's your link there. I think everybody's got that. You can check if you've already, you know, if your Power Cycle Trading account, you can check here to see what courses you have. And then here's what we're going to cover in the course. Again, this is going to start this coming Wednesday at 4 p.m. Eastern, which is 3 p.m. Central. So we're going to start out with part 1 and 2, the live part. And this will be kind of the 5 steps to the perfect trade setup. So we're going to go through the screening, analysis, and how to do that, okay? So kind of a 7-step screening process that pulls together these high probability winning trades on earnings trade, how that's done, you know, kind of my screen process, what I do for that, how it's done. Spend a good chunk of time on that because that's almost the most important thing, really. And then how your option pricing, you know, works to make these trades work, either for volatility collapse or price spike. The secret resources, what I use for the statistics for all this earnings history, you'll get that, how it's used, what it is, and then how to, you know, quickly scan and, you know, do your list and analyze that list. How to analyze that stock screening list, you know, for an earnings release trade or even a post-earnings move. and then what's the best, weekly option strategy to use based on that specific, stock, how it reacts, over its history. And then kind of my formula to create this kind of efficient watch list. So this is a really big part of the course, finding the trades and finding the good high probability trades, what you're looking for. And then part 1 and 2, the live part, will go through the iron condor, that high probability credit spread for volatility collapse, how that's used. We'll go through in great detail the iron condor debit spread for price spikes. And then the big go-to is the double calendar, the go-to earnings kind of strategy. So here it's, in my opinion, the best earnings strategy I've found, as well as an overall excellent option strategy, period. So you're going to learn in depth how to set this up, how, why, and when to do it, the 10 steps that I use for, this guide to these kind of double calendars. The details covered on the earnings double calendar include how to choose the optimum option strike price for the trade, how to structure the initial setup through an option expiration, and then how to adjust if we need to the earnings double calendar into a post-earnings trade that could turn into either a free trade of zero risk. So I'll show you a lot of different ways to do that and examples of those done in the past. And then part 1 and 2 will go into the earnings pairs trade, okay? So pairs trading or spread trading, which is a market neutral strategy. So you'll see how to use this using synthetic options, long and short, to construct a pairs trade to take advantage of any kind of post-earnings trend that you want to capture. All right, so we'll go through in great detail how that's done. So how do you identify and select the best earnings stock pairs for the trade? How we measure the correlation statistically of a pairs trade, how that correlation is identified and measured. So I'll show you how that's done. The sources for the correlation, which is free, and then when to set up an earnings pairs trade. So using synthetic long, synthetic short options for the pairs. So you'll learn that. So it's a course that really encompasses a lot of stuff. And then you're going to get the recorded part of the course, though, just in more detail of these 3 non-directional trades. So you'll get a lot of coverage of how to do these different strategies. So you'll learn them really quick. Plus, you'll have all the good information if you want to go back over it later. So with the recorded part will also go through the long iron condor for selling volatility, and the iron condor, iron butterfly, and the short iron condor. Okay, so that's kind of what covers there. So the option strategy guide, each strategy is explained in depth, how, why, and when to use it, how to construct it, and how to use that pre-earnings implied move calculation, and then how to set the trade up. You'll get a trading library, a bunch of different trades we've done in the past, so you can go back and look at them. Here's just a few examples, but you're going to get more than these. So these are 40 different trades, but you're going to get a big, extensive trading library on these types of earnings trades, Apple, Google, et cetera, just a lot of them that you can go back and look at. There was a really nice kind of review by one of my members, Mary. She said the course explained in clear and simple terms how to trade options on stocks that were coming into an earnings report. Larry showed the specific sources of information he uses to determine which strategy is the most appropriate for the stock that is reporting based on its historical data. He gave very specific guidelines as the use of each and also the exit strategy. Goes through over the material in great detail to show examples of the strategy from past performance. One thing that impresses me with each course I've taken is his willingness to repeat explanations if someone asks for clarification. So I try to make these as interactive as possible so that I can ask questions with you as we go. Schedules the classes for certain time frames, and because he wants to ensure each participant has understood the information, most often the planned time frame he goes over that. Okay, so that was a good review. And then here's just kind of a review of what you're going to get additional bonuses. Now the course is $1,600, but you're going to get it today for $167. But as additional some bonuses you're going to get, you'll get my on-demand earnings course. This is a 7-hour course with all the different, things that we've done. I mean, it's very extensive, but, this Wednesday we start the live part, but you'll get this right away. And so this is, also the recordings, the PowerPoint 428-page trading manual. And so the course goes through the double calendar, the iron butterfly, the iron condor, the short iron condor, and the guide, just very in depth. So you're going to get that with it. And then 2, you're going to get my access to my trading club. So if you do package 1, you'll get the 30-day trial membership. Okay, so you can start this whenever you want. You don't have to start it right away. And then with this club, what you get is you get access to my virtual trading room. So that's where you come in each morning. We're open from 9:30 to 10:30 Eastern, Monday through Friday. So if we're looking at an earnings trade, or if you have a stock that you think you want to do earnings, we can look at that, look at the structure. I'll tell you my opinion on it. And then we're going to also be looking at, as we get into earnings season, the different ones coming up. And so then, like I said earlier, I do a daily video trading newsletter. So after the close, to tell you what my view is on the market, what we're setting up, what trades are coming up. Our trades are then archived, so you can go back and look at them. We do a weekly live Q&A, which is recorded every week, usually on a Tuesday. There's also a trader's educational vault that you get, and then you get 6% discounts on all courses in trading software on my website. So I always like to show this one from Jay, a longtime member. He said, reading books is fine, but seeing the actual option trades set up makes a huge difference. So that's what, try to, encompass in the trade room. And, our big focus is on options, okay? So then bonus 3, you're gonna get my Start Trading Options today. So this is kind of intermediate to beginners option course. So it takes you through the benefits of options versus stocks. Insider tips you want to know before you start trading options, option basics, the mastering puts and calls. So a really good course for you. Add to your library, how option expiration works, and then go through 3 different strategies: the covered call, the income calendar, not the calendar, but the kind of protective covered call with the collar, and then vertical debit spread. So this is a course that you're going to get as a bonus, okay? And then we'll do a follow-up account and support Q&A. Okay, so then you come in, ask questions. Now, also remember that you're a 30-day trial membership. So if you ever had any questions, come into the trade room and ask away. Okay, you get that. And then I'm going to give you my kind of how the pros use the Greeks. So it's a tutorial, 60-page guide with videos on, what the delta, gamma, theta, what these Greeks are, how the option pricing works, market maker's secrets, standard deviation, option delta, probability, so you'll get that. And then you're going to get my 3 updated earnings watch list, 3 top earnings type watch list. So I screen for the stocks coming up greater than 5% moves, 7% max, and 5%. So you'll get that with the course as well. Okay, and then plus in the course there, I'm going to show you how to do your own screening, so you can do that down the road in the future. So here's kind of a watch list that we'll put together. Here's like an example. Here's one that was set up for a max move of 5%. Okay, so we screen this. You can see all the different ones, J&J, etc. So it'll show you the stock, what market it's in, NASDAQ or NYSE, recent closing price, average volume, when the earnings date release is coming up. Is it after the market or before? So here's one that I do. Here's the other screen I do max moves of 7%, and then another screen I'll do is moves are greater than 5%. So you'll get this with the course, but in the course itself, you're going to learn how to do the screening on your own if you want. All right, so that's everything you'll get there. Now, if you want to do package 2, which comes with my alert service, this is for those people interested in this, and this will be $507 today. So for example, so here's a little good feedback from Dan. He said, you're very diligent and totally thorough with your analysis. That is the foundation and success of your alerts. I paid for my subscription with the first 4 trades I took with you when I was just learning how to trade options. So a lot of the members have done this. They just start the alert service, and then I show you, very detailed how to do the trade and alert. They come in the trade room, they learn there, come to the Q&As, and they're learning how to trade options as they're making money off the alerts. So please feel free to share this with other participants. And then here is Scott. It'll be the best investment that you'll ever make. Go with the elite package, great group of traders in the trading club. And again, here's a summary of the, overall, we're running 79% win rate there. And then when I send out alert, again, a lot of members just want to do their own thing, but I'll always give you a trading guide. So it will be a suggested option trade. I always do everything with an option trade that you can use. Yeah, sure, SK. 1 second. 1 second here. Yeah, 1 second here. So we'll get through this. I'll show you some of the alerts that we've done just recently, a couple that we've done. And here's, let me get that to you. Let me know if you got that okay. All right, so I always give the option trade setup that I suggest on that when I send it out. Entry level profit targets based on unusual option activity, based on Fibonacci, all this different ways that I look at profit targets and defense targets. What option series to use, stop loss levels and guidelines, and then trades are listed and archived for you to go back and look at it. So here's just that example of the trade that was sent out on Friday. We had the NVIDIA trade. I can blow this up a little bit more. We had one that we did on MDLZ, which we closed out for a small profit. And we here's one that we did, new USO oil long. So go in here, it says trading around 75.50, trade setup based on a potential for Israel airstrike on an Iranian oil facility, price breaking above 200 daily moving average, positive momentum and momentum upside. On a pullback, initially we tried to get in at 75, but then we increased the offer, our bid. So this was doing a vertical called debit spread. And then we had a couple things on MDLZ. We had a short, I gave updates, different adjustments. Here's an update on the USO trade that we were doing. MDLZ short, went ahead and closed that out for small profit. And then here's the one that we did Friday. It says new NVIDIA long, trade at 124.65, potential breakout trade. Here's the trade setup. It says buy one Condor NVIDIA. And so buy, it says 11, if you can see this. Here's the description. It says buy the 11 October, 126, 129, 132, 135. Call Condor around 84 bucks. Okay, so you'll learn how to do these trades in the trade room or from my course, but this was a call Condor. So it was something, we're looking at, a trade like this. So we're long a call spread and short a spread against it. So really great structure. We do a lot of these at the alert service in the room. Okay, so you'll learn how to do that. And then if I do an earnings trade, it'll specifically say earnings. Okay. So then I'm constantly updating these trades, throughout the day. If you need to do some kind of, adjustment or whatever. All right. So that's what you get there. Now, I do a trade setup video review after the close every day. And then, I have a market video newsletter after the close, which tells you, my view on the market, different trades, things that are coming up. I think, hey, let's take a look at this tomorrow. This is potentially setting up for a long or short. And then we do a trading review and Q&A every week that's live and recorded. Again, you get that virtual trading room, 9:30 to 10:30 Eastern every day during the week, and discounts on everything. So you'll get a membership code. And with that, you can go to the website, and anything that's listed, I'll show you, you'll use your members code and you'll get a 60% discount. So, if you went to my trading software or something right here, and you wanted to buy my scanner or my indicators or any of my indicators tools here, you can just go here, and as a member, you just click on it and get more detail. If you want to buy it, you just come down here, add to cart, whatever. But then when you go check out, you'll use your promo code. You'll get your members code here, and that'll give you 60% off of the price. Okay, so that's for anything on my website, any courses, any trading courses, any software. You can see here's the earnings course, the last go around. So so a lot of different option courses, and you can still get any of those for 60% off with that members code. Okay, so here's some earnings trades that we're going to be going through. I'll show you some ones that we've done recently. KG, he was just an animal on earnings trades. He made more than 1,200 on his first trade that was sent out through the service. But again, here's the earnings alert trade setups. We did showed you some of those earlier, but right at 84% high win rate there. Very selective on these. Now here's the butterflies and long condor trades. We do a lot of these. And so here's a summary of that. Since starting this part of the service back in May of 2019 through Friday's close, done 188 trades closed out, 133 winners, 13 break even, 42 losers, run at 78 win rate, unaudited. Now these trades are really low risk, maybe $50 per spread. Max kind of risk, so on the average, very, very low risk, but potential for huge returns, and we're 2-to-1 to even 25-to-1, okay, based on using butterflies and condors. So these are really great alerts, trades that I sent out on these. Here's one that we just did recently. This was on NVIDIA. This was a long call. Now we just did this here. I'll show you the one that we did yesterday, but here's one we did just recently. I'll go through this one first. So here's one that we set up. We did this on the 24th of September. And then you can see here was the alert trade going out. It says new NVIDIA long, trade at 121, breakout trade above 120. Positive momentum, buy vertical NVIDIA. We started this with the debit spread, buying the 121, 125 at $1.40, okay? And then a little bit later, same day, now it was trading at 121.30. So send out an alert if you wanted, if long that debit spread, then we can adjust the trade to a long call condor by selling the 27 September 127 131. All right, so we adjust this what we call a long call condor to reduce the risk. And then on the 26th, now it's trading up to 127. We were up $95 to $100 on the spread. Said currently close it out, take profit there. I forgot exactly what was going on, but did that trade, close that out, and here was the trade set up. So we got in right here based on our trading model, got out right here. 2 days later is coming into kind of a resistance area here. And so did this long call condor. And so we're long the 121, 125 called debit spread. So you can see that was like a $4 wide spread. And then we sold against it the 127, 131. So we had a max risk of $107 right here. Okay, so that's a max risk debit paid. Potential profit was, that's wrong, it should have been 400, was potential profit 293, 273% return. So need to change that, it should be 400. But anyway, that was one that we set up on that date, and then here's what it looked like. We ended up taking it off the 26th, so right here. So it's getting up to that resistance area. So we just went ahead and took it off in case it came back down. NVIDIA's been kind of moving around a lot. So the spread went from 107. Now blue right here when we took it off is at 230 right there. So the spread had a profit of $123 per spread, 114% return. So that's one that we did. And here's the one that we set up yesterday. Let me show you that one. So the one that we got into on the 24th was right here. Let me pull this back. See, there's this wedge coming in. So the one that I just showed you, we got in right here. And then we had this break, but then it started stalling right here. So we went ahead and closed that out, okay? And then on the close yesterday, we set up a new one right here. Okay, let me show you what the trade was. These are very low risk trades. which I try to really keep everything low risk. I look at risk first and then look at the reward. So here was the trade setup that was sent out. So this was sent out to buy the 11 October 126, 129 call debit spread, then sell against it the 132, 135. So, you know, depends on your entry. It was 84, around 84. So this was $82 risk. Now, if it goes out, you know, between our spreads this next Friday, the potential is to make $218 on that risk of 82. So that's a potential for a 265% return on $82. Then we can, you know, I'll send out alert updates all through the day and next week telling you, you know, if we want to take profit early, if we want to adjust, things like that. So that was one that we did just Friday. Okay. Here's another one that we did. Here was Amazon. Here's another really nice one. Here's one that we did on the 11th. And Amazon was trading at 180, 130. So you can see it's very descriptive when I send the alert out. It says here, new Amazon long, trading at 180, 130. Cycle low, retracement reversal off 200 daily moving average. Positive momentum and momentum upside cross. These are things I look for. Target 1, 185. Target 2, 190. Buy. This is a condor. Buy the 82.85, 182.85. 192.5, 95 at around $85. See how that one similar to the one we just did. Then here's an update here. Now it was trading at 183.50. You know, what we did here was we adjusted the spread up a little bit. I won't go through all that, and then here's on the 20th. Now it was trading at 190.16. If long adjusted call condor, here was the adjusted trade, 182.5, 185. Short the 195, 197, going out at max profit, $154 per spread, 160% return. All right, so that was sent out, and here's the trade. So we got in right there, perfect, really good entry. Got out right there. So here's a trade profile of the trade. So here was going long on the 11th. It was trading at 180, 130, went long this spread here. And also short against it, the 195, 197.5. Total risk, $96, $2.5 wide spread. Then potential profit is the difference, 154, 160% return. But we have a super defined low risk trade. And this went out perfect, right there, smack dab in the middle. So this was a max profit trade right there. So it went from our spread entry cost 96 to 250. So here we are, $154 per spread. That's per spread. So if you did 10, you know, you're up 1,540. Anyway, so that's a per spread profit. So that's Amazon. And then, here, Joanne, here's the link again. Use this, sorry, hold on. Let me get you the right link. 1 second. And we'll go back through the course details here in a minute. I'm just showing you kind of review some of the trades that we've done recently to give you an idea of what you get with the alert service. And then here is here's that link again. If you want to just sign up for either package 1 or 2, use this special link here, Joanne. And then use earn 15 small cap. Okay. So here we do a lot of these trades, calendar diagonals and calendars. So these are kind of the bulk and then butterflies, et cetera. So you can see here through yesterday, we've had 302 trades closed out, 219 winners, 17 break even, 66 losers, run about 78% winning rate unaudited, but these are really great trades. We do a lot of these. And here's one that we did not long ago. We did the MDLZ here this week. It was a small winner. I'll show you that one real quick here. Let me show you this one first. Some are small, some are big. You know, so here's a really big one. This was one that we did on Konica. This was a put calendar. So we set this one up for a downside move on the 4th of September, 109.85. So you can see here it says, trading around 109.85 daily, negative momentum downside cross. Target 1, 108, target 2, 106. Here was buying a put counter diagonal. What is it here? The 20 September, 6 September, 109, 106. So you'll learn these trades either in the trade room or from my course. Set this up around $1.65. And then here's on the 7th. Now it's trading at 106. So we did an adjustment here. We adjusted the trade and we moved down the short strike. We locked in a big profit here. Then here's on the 10th. Now it's trading at 104. So if long the 20 September 109, short the 13 104 adjusted trade balance before today's close, we did another adjustment here. And we adjusted this into I believe we adjusted this into a butterfly. So anyway, we did a lot of different things on this one, but this one, then look at this, it's trading at 104, then at 103.59. So we got into the trade here when it was trading at 109.85. So again, a lot of members just do their own thing. So here's the here's kind of the step-by-step this trade, how it worked out. So we set this up on the 4th, 109.85, and then we had a profit take, an adjustment around the 9th or 6th September. Now it was trading at 106.06. And we also then had a profit take on the 13th. It was trading at 103.50. Look at that trend down, perfect. So we got in here, we did an adjustment here, came down here, closed out the balance of the trade right there. So here was the trade entry, and then we adjusted this to a 20 September 109 put short the 13 Sep 104. The original trade we had set up was, let me back up, this one had such a great profit. The original trade was the 109 106. Now what you're going to see here, we rolled the whole spread down to lock in the profit. Okay. So now we're along the 109. Short the 104. We were short the 106. We rolled that short spread down. And then we had some profit take on it on the 6th. Now it's trading at 106.02. So the spread was up $225 per spread, or 274% return. You can see it went from our adjusted price, 82, was now our adjusted spread price, blew to 307. We're up 225. Okay, and then we did another adjustment where we adjusted down the whole thing. And now, instead of being long the 20 September 109 put, we adjusted down to the 106, locking in huge profit, and sold lower down the 101 put, all right? Now, you'll see then what happened on this trade. Now we adjusted, we had such a big profit, we had a credit. This just to show you the accounting, because we had, over $400 profit, so we just rolled down the whole spread. So now we're in basically on an adjusted basis with a credit of 77. This thing blew to 335. So the max profit when we ended up getting out was up to $412 right there on zero risk, because we'd already locked in everything earlier. All right, so that's a look there. And here's just another one that we did. This was on the 14th. This was on the long call condor on Boston Scientific BSX. We got in here on 76.20. We had profit take on the 19th, 20 to 22. And I'll just kind of run through this pretty quick. So here was the trade entry, 76.20. It says cycle low retracement reversal off 21, positive momentum, target 1, 77.5. High open interest at the August 16, 77.5 call. So we did a diagonal here at around $1.25. 19th, we had an adjustment. 21st was trading out 78.78. We did another adjustment. 22nd, we started closing it out. So these are very descriptive when I send these out. And here's the trade. So got in right there. And then we got out right there. We had a really nice run to the upside. So we set up the initial trade. It was trading at 76.20. We did an adjustment where now we had it long the 30 August 76 call, short 23 August 78.5. And then we took some profit. Now it's trading at 87.68. And our spread that we were in at adjusted price of $1.35 now is at $2.38. So we were up $103 per spread, 76% return there. And then we did the next couple of days later. Now it was trading. We had this trade. We had set up this and converted this to a call Condor, and we adjusted our price down to $60. So now we're long the 76, 78 and a half, short the 79 and a half, 82. Okay, so you can see here, we just kind of go through what this ended up. So these are kind of things we're always trying to accomplish. So now we adjusted this trade down to a total risk of $60, and the trade was up to 178 on the spread. So we were up $118 on $60 of risk, 196% return. All right, so these are things that, when I send out the alerts, we're always looking at these kind of potential ways to, update. Now, here's another thing that I'll send out. These are what we call our lotto trades. These are penny trades. So here are a couple that we've done here that were just amazing. This was one that we did on Tesla, and this was one that was sent out to all the alert members. And you'll see here it says, new Tesla long binary monthly butterfly option penny trade. Okay, so very descriptive. So what we're looking at here is a super low risk trade with the potential for big, huge reward, which I call kind of a lotto. So we set up this trade targeting 200. Right there it says expiration pin at 200. And so it tells you exactly what to do. Buy a butterfly, 197.5, 200, 202.5 at around $12, 12 cents, all right? So that's your debit pay. Max risk $12. Then on the 16th, this was on the 8th, 16th, now on expiration was going out. Now this trade was up $205 per spread. We had it originally set up 12 cost, $12. And then you can see at the end of the day, I said, wow, almost perfect pin. Actually, it was a pin right at $200. And this spread was trading up $230 per spread, 1,916% return. All right, so these are another kind of alert you may receive. So here's the trade setup, here was the pin, and here was the trade that we did that was sent out that you could execute. 197.5, 200, $12, 12 cents debit, $12 spread width 250 less your cost 12, potential return 238, 1,983% return. And it pretty much made that. So this was the lotto trade. So here it goes. Here was at expiration going out at 200. So this, we're scaling out, but here's where it went out. So it was up $238 per spread on that risk of 12. That's 1,983% return. Here's another one we did not too long ago. This was on GLD, the gold ETF. And so you can see here, again, it says new long GLD long binary call butterfly option setup. All right, so go through that, and then we actually adjusted this trade up a little bit, and then here it is going out at expiration. So this was almost a perfect pin as well. And I'll show you this one, and then any more questions, please let me know. And this one was a really good one, so set this one up, and then we're trading and we're looking for a pin at 230. Okay, so this one ended up making up to $203 per spread. This was up 700% return. All right, so this trade was set up for $29 of risk right here. You can see the 127, 130, 130, 233 call butterfly. Risk 29 cents, $29, spread width 300, so potential $271 if it goes out, at a pin. Potential for over 900%. This one actually made about a 700% return, so this one turned out really well. Not as good as Tesla, but it goes out right there, pretty close to that 230. So this went from 29 cents, $29 to $232. So this was up $203 per spread, 700% return. So these are the kind of things that you'll get with the alert service. Okay, so it could be a binary butterfly, could be an earnings trade, could be a breakout. Now here's an example of a breakout trade or a credit spread. So here's one that we did. We've had 172 closed out, 125 winners, 6 break even, 41 losers, 76% win rate. Here's one we did not long ago. This was a short trade on SPY, basically just a day trade. So it was trading at 549. So we did this with it says new SPY retracement failure short, was trading at 549. Testing the 50 moving average, downside break, etc. So this was set up, says buy vertical SPY, 548, 543, put debit spread at $1.35. And then it was trading down to 539. And then it was trading down. This price is wrong there, but it was trading down hard. So we got in here, we got out right there the same day. So it was trading at 549, and we ended up getting out right here at 539, right there. So did this as just a put debit spread. This was sent out to all the members. Spread with 500 bucks. Risk was 130. Potential 370. But we went ahead and closed it out on that big spike below. Right there. So this went from 130 to 361. So we're up $231, 177% return during that day. So that's everything. And then any questions, please feel free to ask. And again, here's the link. Make sure to use that special link here and take advantage of it today, 167. All right, thanks Matthew for being here. And Tony and Tom, yeah, thanks for being here. So that's everything here. And again, so if you want course package 1, now we're going to start the course then this Wednesday. And if you want the alert service added, that's 507. You get all 5 of the different alerts for the next 4 months. And here's the dates that we'll start on the live course. This will also be recorded, so you get all the recording as well. So we're going to start this Wednesday, October the 9th, and this will be ahead of JP Morgan. We'll probably set a trade up on JP Morgan. That will be on Thursday. So you'll learn the trade setups, and we'll probably do that trade setup on JP Morgan on Thursday afternoon. All right, so we'll get you prepared. So jump in. It's Wednesday the 9th, 4 to 5 Eastern. So 3 to 5 Central, and then Thursday we'll do part 2, and then we'll finish up the following Monday. Okay, so a lot of great stuff that you'll learn. And hey, you're welcome. Thanks, Richard. Oh, thanks, Rich. Thanks very much, everybody. If I may pass on those comments. So here's from Richard. Thank you so much. Appreciate that. That keeps me going. That makes my day. And hope to see everybody on this next Wednesday at the course. Thanks again, everybody. And have a great rest of your day. I hope you enjoy the rest of your Saturday, maybe a football game or outdoors or whatever. Okay, thanks again.